Australia's rate of unemployment has indicated no change in September and is steady at 6.2%. Despite this, the number of jobs have been found deteriorating throughout the month. I'm on the phone with Gavin Friend, market strategist with NAB, to look further at this and more coming out of the Australian economy. So, Gavin, Australia's seasonally adjusted unemployment rate remained unchanged at 6.2% from a month earlier, while the economy lost 5,100 jobs, and the number of unemployed declined by 8,100. Looking at these figures, what is this indicating for the Australian economy?
The 5,004 was clearly a disappointment. We in the consensus had looked for something like a 10,000 rise on the month, and the breakdown revealed all the losses came in the full-time jobs component, down 14,000, whilst gains were in part-time jobs. So that kind of worsens the headline news, if you like. Now, the 5,000 fall reduces the trend for employment growth to just over 12,000 jobs per month, which, if that's sustained, it would be below the 14 or 15,000 jobs per month that we need to keep the jobless rate stable, which is obviously a key component. I think you pointed out there that the jobless rate was indeed stable at 6.2, but this was really helped out by a 1/10 fall in the participation rate to 64.9 from 65%. I guess we caution about being too bleak here. To 2 decimal points, the jobless rate actually fell a tenth, which is obviously good news. And in addition, there was something like 8,400 jobs lost in the state of South Australia. Now, that's not consistent with what we're seeing in other more detailed jobs data, such as that provided by the SEEK organisation. So we'd be looking for that 8,000 loss in South Australia to reverse in October. I think overall we'd be saying that the evidence has been accumulating for an improvement in the labour market for a while now. And we released our latest NAB business survey on Tuesday for the month of September, and that showed that the employment index rose strongly from -1 to +4, and above its long-term average. So I think for us, things are starting to improve, and we maintain our view that this is not the start of a weaker trend, if you like, and does not mean that the RBA will be cutting rates just yet.
You've touched on it there. The latest trend does not indicate that the RBA will cut interest rates again, but is there any other indication that they will?
The RBA sees an economy which is gradually healing itself. I mean, the growth is still moderate. It's below trend, which is probably what you'd expect at this stage in the cycle, but it's being helped out by a number of things, by the low interest rates and that kind of thing, by the low Aussie dollar, which is helping out exports. I mentioned the NAB business survey, and if we looked at the main components of that survey, it showed another rise in confidence, business conditions remaining pretty stable but above trend levels. I think for the RBA, it's just trying to strike a balance here. It wants investment in businesses and that kind of thing to pick up. It doesn't want to see the housing market go. I mean, the RBA has said the policy needs to remain accommodative, and that's right. But I think the way we read that is that means the way things are going to very steady recovery, helped in part by the lower Aussie dollar, which has come a significant way now, thanks to the gains in the big dollar, and that's helping out areas such as services, exports and tourism. And for us, this all means that the RBA will sit on its hands with the next move coming as an up move, but this will obviously be sometime well back into 2016, 2017.
So you mentioned balance in your last answer there, and I understand you also talk about divergence in the Australian economy and the direction it's heading. Could you expand on this?
Well, I guess a lot of people are focusing on the global backdrop, and particularly the slowdown in China and what that might mean for Australia. And this is it's a very good point. I mean, nobody knows where that is going, where the global dynamics are going. We can all have a view, but we don't know. But for us, it's important to understand that whilst China moderates its growth and tries to move to a more domestic demand-led economic structure, China is still importing huge, in fact record amounts of iron ore and minerals and the coking coal from Australia. The price at which it's paying is obviously a lot cheaper, and that has ramifications for various parts of the Australian economy. But it's still growing strongly in that point. This is not the time, I think, to start thinking about, things getting much worse. This is the time to thinking that, we're seeing the bottom of that particular rundown, and whether things can start to improve from here. And what I'm saying in the divergence is that, you, from an investor point of view, you get people falling on both sides of that argument, and there are people that think the RBA will need to cut further. Because of what's going on in China. Our view is that things in the non-mining sector are improving, and no amount of interest rate cuts are going to help out the mining sector.
That was Gavin Friend from NAB with me there. Now, if you enjoyed that, then make sure you're clicking back to Dukescopy TV for even more insight and analysis like this. Bye for now.